Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'm going to interject my financial opinions as we go through it. Um, Generally related to three different topics: wealth building, commodities, and/or financial topics. So let's dive in. Let's take a look and see what people are sharing. And here we go. If you want to follow me at Finding_Finance, and if you want to join our community, finding-value.com, where I dive deeper into the sectors, deeper into the individual companies, the technicals. We do have a midweek update that I'm releasing today as well. So you get to see how I'm positioning in this market, what I think are good companies and good setups. You get to see it real time. So here we go. We have Grayscale Bitcoin Trust. So I was looking at Bitcoin and some of these ETFs just for the heck of it. I see a lot of the technology stocks starting to roll over, and my eyes have been focused mainly on Bitcoin and cryptocurrencies to see how they behave. Um, Crypto was brought about during the recovery phase, the beginning of the recovery phase of real estate. We have not seen this go through an expansion phase where interest rates go up and things start to slow down. So I'm real curious to see how this handles this type of market environment. I also know that there's no real inherent demand for crypto, much like commodities that are used in products. So I'm not sure exactly what happens if you get into a gigantic bear market where Bitcoin goes down 95% and the miners can't make money mining Bitcoin. So a lot of the big dollar amounts might be transferred to the transactions as fees. They're not being subsidized by coins in the system anymore. I'm very curious to see how that actually works and how all of that transpires. But this Grayscale Bitcoin Trust looks absolutely like garbage with the big bearish engulfing candlestick that just showed up here on, what is that? I think I had that on the weeklies if I can remember. Daily or weekly, I can't remember, but that's a big candlestick. And that generally kicks off a downtrend, or if it's located at the end like this of a consolidation, that's not good. Floodgates are open, Microsoft. So the first 200-day SMA test since March 2023, and it just blew right through it to the downside. This does not look all that inspiring here. Yes, there could be a bounce over the next few days, but I would suspect that the momentum is going to carry it lower. Why are we looking at tech stocks? I know I talk a lot about commodities. Well, this could easily have an impact on the entire market. As things sell off, it could, and I don't know for sure, impact commodities and other sectors depending on how fast the sell-off occurs. And the faster and more powerful it is, the more likely it is to grab everything in the market and yank it lower. We very well could see a rotation of money from technology into commodities and other sectors like precious metals. And I think that is a likely case. But in the short term, depending on how fast it falls, we could see everything sell off for a period of time. That is definitely a possibility. Home builders continue to act strong. Now, home builders, they kind of move in their own, they move to their own beat. They can somewhat bypass the tech sell-off and maybe even commodities and everything. It kind of, moves to its own drumbeat. This is breaking to the upside. It looks very strong. And this is the ratio chart of home builders versus the S&P 500. And we did a pretty good job, or I did at least, catching the bottom of some of these home builders on some ridiculously gigantic fractal charts. Like they are very big charts sitting on top of support, and they just ripped the past few weeks. I think that went up probably 40, 50% in a few weeks. So I think home builders look fantastic. I think they're front running the weakness in the tech stocks and front running the decline in interest rates. So insiders, is my guess, is they're front running money flows that are going to come into home builders because we're still short in the housing market, and affordability is probably going to get a whole lot better with interest rates coming back down. And that's people trading with insider information and looking at charts. Here's one thing that I do find kind of weird. And this is the data that I'm looking at. So crude oil is still consolidating. Some people think it will crash or go lower from a potential slowdown in the economy. Longer term, I think we go much higher, but short term is anyone's guess. Short term, the equity charts are sitting on top of breakouts and could potentially run. Shouldn't the weakness in oil be expressed in the equities? Question mark. So here's oil, and you can see oil has fallen the past week or month, and we're on top of this big consolidation breakout where we've been consolidating on top of it. I'm looking for a potential break higher, obviously, but we could head lower before breaking to the upside. Very much could be the case. But when I go and I look at the equities, they're not positioned like that. They're positioned on top of all of this support with green candlesticks going up against the downward move in oil. So this is XLE, which is the Energy Select ETF. We can look at XOP, which is also on top of a falling wedge, which is a bullish formation to go higher. And then we've got PSCE, which is right underneath resistance, ready to potentially break to the upside. And I know that we've recently had some deficits for inventory draws, which is bullish for oil. Now we've got two strong entities going against each other. The slowdown in the tech stocks and potentially a slowdown in the economy, which we can see in the yield curve on inversion, the lowering of the 2-year yield, and the unemployment rate going up. Now, sometimes in the early innings of a slowdown, we see crude oil spike. Is this the beginning of the spike? And that is where I don't have a great answer for you. We're looking at this. A lot of the charts look fantastic. I am positioned for this to go up. And I'm looking at the short-term market movements of yields, the yield curve, and unemployment rates. And again, that doesn't mean that we immediately have a slowdown. We could still be months or years away from that slowdown. A lot of the times, the 2-year yield takes some time to go down, and maybe we're 6 months to a year away from that. But right now, the positioning looks pretty good in oil, at least oil equities, and we could go higher. And it basically is going against all of these other charts that I'm seeing. Here's gold. Gold is breaking out against crude oil at the moment to the cheap side, where crude oil continues to get cheap. Is this a false breakout and a reverse, or does this signal the market conditions of a slowdown that is coming? What do you think? So this is gold versus crude oil, and we're at 32. A very cheap ratio of gold to oil is about 30. When you get above 30, that's basically when you want to buy. We are at that cheap location. Is this a false breakout, or do we actually run up and then cycle back down? That I don't know. But right now, it definitely looks like it's breaking to the upside. I would say this is going to go higher, where gold's going to outperform crude oil. That also could be a signal of a slowdown coming in the market. So when you look at these ratios, when gold outperforms crude oil, that's almost always a sign that you're either overproduced oil, which I don't think is the case, or you're coming into a slowdown, which I think is a higher likelihood. Or it's a false breakout, and it's just hitting a bunch of stop losses to reverse lower. And I don't know if that's necessarily the case, but this is going up, and it's at a very cheap level. If I learned anything over all these years, what you could do is cost average in when this is cheap up here the entire way, and you'd have one heck of a position for the bull market in crude oil after the slowdown comes through. If no slowdown does come, you could continue to cost average in, and you don't miss on any sort of gains that crude oil could have in the short term. So cost averaging in is a good way to look at this, I think, from a strategy perspective. We got Heisenberg, and he says, off-topic question. If I offered you 30% more than the current valuation of your house on Zillow or whichever comps you use, would you take it right here, right now? For example, your home is worth $1 million. I give you 1.3 million. You move out in 72 hours. Yes or no? My answer is no. For 72 hours, that's way too short of a time frame. And even though it would be a good chunk of money, there's other things that I would have to line out for that to work. But 72 hours is too short of a time frame, and I just don't feel like moving, even for 30% more than what my house is. If I had more time and I looked at the market of potential places of where I wanted to live, and then I looked at the math because I have a really cheap mortgage on my house, 2.75%. My payments are literally, it's like what car payments are for most people now. So that's really cheap, and I like that. But 30% is a lot of money. I mean, don't get me wrong. Uh, if I went and I looked and I were to buy another house, I would probably buy something that is a good chunk more of money, even more than 30% more. And that 30% would be on top of the equity I've built in the house, would be a down payment. So I would still have a substantial loan, and maybe I could be convinced of it if it was not in 72 hours, but I'd have to look to see the homes that I'm really interested in. And what I would do is I'd buy a house maybe that has more property, but more property in a location that I really like, it's probably going to cost more than 30% more at a minimum. And then I would have to have a higher interest rate. But I do think if interest rates fall, I could refinance it, maybe to a better level, maybe, maybe not. So with 72 hours, I probably wouldn't do it. I don't like moving crap. Another huge draw. This is zero hedge for oil. Crude oil down 4.5 million barrels. I don't know what EXP is, minus 1.1. Gasoline's down 2 million, distillates down 0.3 million, and Cushing's down about a million. CTAs are minus 100% net short. Yeah, this is an interesting setup in oil here. We've got this perceived slowdown that people are looking. I think we're early on the slowdown call, but I think it's in the beginning stages of it. And technology is going to be the leader that probably leads it to the downside because that's the most overvalued sector. But we still have these big draws coming in oil, and I cannot not be long in oil. I just have to be. The charts look good, and these draws. So yeah, it still looks good. It says, are Canadian stocks out of control in an unsustainable uptrend? Or are they just now finally starting to get going because of all their exposure to leadership groups like financials, industrials, and materials? I think it deals more with the currency. If you look at the Canadian dollar divided by USD, that is bottoming out. I think the dollar is about to drop. That's my guess. And people are positioning in that before the dollar drops. And we've seen a lot of these indices go way up off of currency exchange rates. So that's what I think it is. Money wisdom, and this is Peter Lynch. The key is to save as much as you can as early as you can. And that's exactly what I did with my life. You guys want to know. I saved as much as I could up front. I mean, I saved a lot, guys. I lived at home for 2 years, saved everything I could. When I was young, I bought a foreclosed condo, and it was really cheap. We're talking like uh, not six figures, but five figures. And I got it for really cheap. I had to fix some things on it, nothing major. And my payments were really low. So I saved a ton of money, all the way up to about 30, early 30s or whatever. And then you have kids and you got to find a place to live and yada, yada, yada. Your expenses go up quite a bit. So I saved as much as I could as early as I could. And then I did invest a lot of that money. Commodities continue to outperform tech. I don't think people realize how intense the capital rotation could be if this relative outperformance sustains. Money managers don't want to lose clients, so they buy what's working. And what's working is commodities and metals. I foresee the metals being precious metals. I think precious metals are going to do really well here in the short term. They do very well when the yield curve uninverts and when people get afraid. That's the safe haven asset, and that's where it gets the name from. So the safe haven asset works under certain market conditions where we just entered those market conditions a little while ago. It front ran it in 2022 when the yield curve was inverted, and now it's been kind of just drifting higher. So I think silver's going to rip. I think gold's going to rip because we're in the right market conditions for that to occur in. He's completely right. Nvidia, it's a beauty, and he's got a double top and then a potential move lower, which would ultimately be a shoulder head shoulder if that does play out that way. A lot of people are looking for potential tops. I don't know if it's the top yet, but a lot of people are getting pretty bearish on it. Guys, check out my. I was on a panel with Trader Ferd and Jesse. If you want to see that interview, it's on the web. It's on the Twitter here. QQQ, man overboard, breaking through support. I've been waiting for technology to roll over here. I have been a little early, not too early, but a little early on some of my calls because I kept calling for technology to eventually roll over. I started chatting about technology rolling over in 21, 22. I definitely went longer than what I thought, but I do think that it's looking worse, or I should say better for a rollover now, but worse for technology stocks and the owners of technology stocks. It is looking a little bit more sell heavy, is what I'll say. Jeff says, for 5 straight months, the ISM service employment gauge has been in outright contraction at 46.1. It is consistent with April 2001 and early 2008 and COVID. The Fed's median unemployment projection for 24, 25, and 26 is 4, 4.2, and 4.1 respectively. Good luck. So what he's saying is ISM services employment, 46.1, it indicates rising unemployment. And here we are ready to turn higher. Those are also coincident with recessions. So it's looking a little bit weak over here. John Templeton says, don't get frightened out at the wrong time. The time to get rich is by buying when share prices are low. That's the same quote as Buffett, be fearful when others are greedy and be greedy when others are fearful. They're both exactly right. And where I made a lot of my money is when I purchased when everyone else was very fearful. Made a lot of money, guys. You can make a ton of money when things go down a lot. And there are strategies that you can deploy where you keep a little bit of dry powder for that if it does occur. City on copper, it says by Q4 2024, we see copper back at 9.5 thousand per ton and rallying further to 11,000 per ton by 2025 on a Fed rate cuts led recovery in global manufacturing sentiment and second half 24 inventory draws deficit. We believe the refined stock build to date was mostly, if not all, driven by destocking by consumers and scrap dealers. And that's at 9,000 per ton. This process will reverse, is what he thinks, or what Citi thinks, I should say. They could be wrong, though. If there's a slowdown, we could see money rotate a little bit different. But yeah, longer term, copper is going to be a big winner. CHK doing their part not to be part of the problem. They have lower quarterly production figures for 2024 guidance out in the future. So they're doing their part. They've lowered production and they've got lower guidance out in the future for Haynesville and Marcellus. So the time to go long in oil is when everyone stops saying it's time to go long in oil. I agree. I like it. Long way to go before gold or GLD shares out, makes a new high. Long and strong gold and silver until then. Totally agree. And that's gold's commodity. And this is GLD US equities. GLD US equities has a long way to catch up with the gold price. And just like that, WTI back to being fairly valued. So total commercial petroleum stocks, again, they've drawn down, and now we're at fair value at this current time for oil, given commercial inventory levels. Breaking, July CPI inflation in Germany unexpectedly rises to 2.6% above expectations of 2.5%. Just hours ago, Germany reported a surprise minus 0.1% drop in Q2 2024 GDP. Germany's now has rising inflation with falling GDP. The era of stagflation has begun. So it looks like we could be entering GDP contraction and inflation. And you know what? It does very well. Metals do very well under that type of environment. And that's where we're going to end it, guys. So that's what we've got for today. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. We have Mayday coupon code that is still active. And we'll catch you later, guys. This is Finding Value.